Analysis statements. In a parallel universe called U.S. banking, analysis statements are really invoices. It's very important to understand what they are, how they're used.
What are analysis statements?
Well, analysis statements are simply a way that a bank bills customers for treasury and transactional services. They're very similar to invoices, yet they have some differences.
What are some unique components to the analysis statement?
Well, first of all, the part of the analysis statements that's similar to traditional invoices are the price times volume. For transactional services, this may be the number of checks times the price per check. That's what's similar. Some of the unique components of analysis statements, what makes them analysis statements, have to do with reserve requirements, the earnings credit rate, as well as some of the calculations for compensating balances.
Is there software to help with this?
Yes, there are three main vendors that provide software to help with analysis statements, to help process and track volumes, compare them with what you've been invoiced for. And there's also software that can analyze the trends that you have for using different types of services to support your businesses. Earnings credit rate is the rate that the bank uses to pay and provide you with some sort of compensation for the fact that you leave balances in their account that they cannot pay interest on. And without boring you on all the details for why they can't pay you interest on them, it's just important to know it's a way of providing value for those balances. The reserve requirement is simply what the Federal Reserve charges the bank. If a bank receives a deposit from someone, let's say $100,000, the reserve requirement is currently 10%, the bank is able to lend out $90,000 of that. They need to maintain $10,000 on reserve. That reserve requirement reduces your compensating balance, which is how they use to calculate what value those balances have to you as an alternative way of paying for your invoice or your analysis statement.
He looks terrible in yellow. Is that really yellow or is that just dirty?
What is the best method of allocating charges?
Wow, that's a very tricky question. What's the best method? There's really not a single best method for allocating charges for every organization. It really depends on the particular type of organization. A direct charge works well in some organizations where you have a nice matching of the services to the particular activities that are supported. Other methods of allocating a general charge can help a treasury group ensure that you're using commercially reasonable procedures and then allocating those charges out, whether or not an area uses positive pay, for example.
Let's say I'm spending $100,000 annually on services. How much scrutiny is warranted?
Well, we recommend that you treat these charges just like any other invoice. How much scrutiny would you put on a $100,000 invoice? There would be a certain amount of care and concern.
Why do they make errors?
Why are there errors on analysis statements? Well, banks may make errors on analysis statements for several different reasons. One has to do with manually inputted volumes. Certain systems don't feed directly to the analysis system, and so they're keyed in, and they may make some errors on those. That's why it warrants reasonability checks as well as comparison of volumes. The second reason why banks may make errors has to do with the feeds from various systems to the analysis system. Banks may have 50, 100, maybe even as many as 500 different systems, whether it's ACH, wire transfer, demand deposit account systems, branch activity. All those systems need to feed the analysis process that they have. At any point in time, if those feeds break down or if there's a delay or data is lost, those items won't make it onto your analysis statement. Those types of errors are usually related to you're not charged enough. Other errors on bank analysis statements come from the fact that banks, like other organizations, need to increase their prices from time to time. When they increase their prices, that process tends to be fairly automated. If you have customized or negotiated rates that extend for a certain period of time, you may notice when they have a price change that your agreed upon rates may be overwritten by some of the standard rates that they charge. That's a particular time where you want to review your analysis statements to see if they got your pricing table correct. There are two main types of bank errors, those that are in your favor and those that are not in your favor. The bank errors that are in your favor tend to be caused by feeds from various transaction systems in the bank don't make it all the way through to the analysis system. This is a breakdown, and that tends to be in your favor. The types of charges and types of errors that occur that tend not to be in your favor have primarily to do with manually entered items, where there can be a key punch error at the bank that feeds the analysis system, and also primarily occur when there's a pricing upgrade, a general pricing upgrade, and you have negotiated rates. These are often overwritten at that time and require close attention.
What are key points to remember about analysis statement?
What's important to remember about analysis statements is this is a good clue as to what's going on in the organization. This is a bill. It's important. It's important in terms of how you disperse your funds. It provides an important method of allocating those charges to your organization to ensure that you're doing the right things for your business.